Hello everybody, welcome to Market Musings. Today we have with us Dr. Prasanna Chandra. Dr. Chandra has over 5 decades of teaching experience in various postgraduate and executive education programs. Sir has also served as a professor of finance at the Indian Institute of Management, Bangalore for over 2 decades and also as a visiting faculty at the Southern Illinois University, USA. Professor Chandra has written around 10 books and also published in esteemed journals and business periodicals. He has been on the boards of various companies and also as a member of the SEBI Committee on Derivatives. We are so honored to have him here today. Good morning, Professor.
My pleasure.
So delighted and happy that you're back to campus, and we're so happy that this book, Behavioral Finance, that you've written has been so well received by the academic community and the business professionals. We're looking forward to learn a lot from you today, Professor. So Professor, we just wanted to know what is behavioral finance and how is it different from the traditional investment theories that we listen about?
If you look at the history of finance, you find that it can be divided into 3 broad phases. Before 1950, you had what I call prototypical behavioral finance. Important developments in the realm of rational finance or standard finance, beginning in early 1950s. And if you look at the central pillars of standard finance or rational finance, they are expected utility theory, modern portfolio theory, capital asset pricing model, efficient market hypothesis, standard life cycle theory, and option pricing model. All of them were developed during that fertile period from 1950s to 1970s. And these models assume that human beings are perfect, rational, economic creatures, devoid of emotions, totally free from social and other influences, focused on maximizing their utilitarian benefits. Real life economic agents are very different. In late 1970s, Daniel Kahneman and Amos Tversky were at Stanford University. They were cognitive psychologists, and they found that expected utility theory did not satisfactorily explain how people behaved in face of risk and uncertainty. So they developed prospect theory as a challenger to expected utility theory. Subsequently, a lot of others joined the behavioral finance bandwagon, but the initial impetus was provided by Kahneman and Tversky, cognitive psychologists. In fact, there is a very famous line of Amos Tversky in which he said, "My colleagues in economics department study artificial intelligence. We study natural stupidity." That resonated with me because as a participant in capital market from 1970, I realized how error-prone various participants were, but the models that we were learning and teaching assume that economic agents are perfect, rational creatures. And they started the heuristics and biases approach, where they identified a number of heuristics and biases that characterize human decision makers. That work has expanded considerably in the last 40 years or so. Today, probably 200 such biases have been identified, and many of these biases characterize investors. As an investor, I am equally prone to those biases as any intelligent person would be. We are wired that way because we have evolved over millions of years. First, the brain stem developed, which regulates respiration, heartbeat, etc., which is automatic. Then the emotional brain developed. And emotional brain developed over tens of thousands of iterations. So it is in version 5. The rational brain or cognitive brain is a recent addition to human brain. It is in version 1. So if you look at how people behave, you find that they are guided more by
Emotions,
less
yes,
by reason.
Yes.
And that is what we see in the market all the time. Look at the market in any period, you find emotions playing such an important role.
So much of panic selling, panic buying,
Yeah, you
herd
have
mentality.
fear, greed, envy, chasing trends.
Yes, sir.
All these are human emotion, and we are guided by herd instinct.
Yes, sir.
We're bored, so we want to act all the time.
Yes, sir.
All these are human traits which influence our behavior in all walks of life, more so in the realm of investment, because here you see the market all the time. And today we are more vulnerable to those emotions because we are bombarded by information and stimuli all the time.
Yes.
I feel that 1970s was a better decade for investors because we got information belatedly, we had time to reflect on that information.
Process it and
Today we get information instantaneously and we tend to react because the emotional brain is in version 5.
Yes, sir.
And that is what we see all the time.
Yes, sir.
And in particular, I found that some of these emotions really corrode investment performance dramatically.
Okay.
I have seen investors for 50 years, and I found that very few investors have been able to earn a rate of return commensurate with what Sensex may have provided over this 40 years. If you look at 1980 to say end of 2021, I'll ignore 2022 for the time being, but because if you look at Sensex, 100 to 60,000,
yes.
and it provided a return of almost 16% compounded annual growth rate. Even 1990 to 2020, you find that returns have been about 14%.
Yes, sir.
But when I talk to a number of investors, small and big, I find that very few people have been able to achieve a return which was commensurate with what Sensex delivered.
Yes.
And that is why you find that most of the investors have underperformed. There are two concepts, very interesting concept. Investment return and investor return.
Okay.
Investment return is the geometric mean rate of return earned on an index.
Okay.
If you look at Sensex, you may say investment return in the last 40 years or so has been 15 to 16%. Is that clear? But if you ask most of the individual investors what kind of rate of return they have earned, you will find that they have earned 8%, 9%, 10%, 11%. Investment return is calculated as the geometric rate of return, and that is what is reported in all the mutual fund performance data. Investor return is the internal rate of return earned by an investor on his cash flows. So if the market goes up and the investor invests in a mutual fund when the market has risen substantially, and then when the market falls precipitously and the investor exits, then the cash flows of the investor will show a very pathetic rate of return.
Yes, sir.
You find this all over the world, even in Magellan Fund, which was run by the legendary Peter Lynch. Over 13 years that he ran the fund, the geometric average rate of return was close to 29%. But the average investor in Magellan Fund during that period earned a rate of return, which is the internal rate of return on his or her cash flow, which was barely 8% or 9%.
Okay.
So there is a huge behavioral gap here.
Yes.
And this is well documented. Dalbar studies in the US have shown consistently that investor return is significantly lower than investment return. To get investment return, all that you have to do is stay put through all ups and downs. Don't get excited when the market is in poor money at that point of time. Don't get depressed when the market has fallen. Pull out at that point of time. That has been the single most lesson that I have learned in my experience. You require a time perspective.
So, Professor, we've talked briefly about these biases before. What are these biases exactly in behavioral finance?
In the real world, we find that investors are prone to a variety of biases. Without getting into details of those biases, let me identify a few biases which I believe are very important. I will use the word mirrors.
Okay.
M is myopic loss aversion.
Okay.
I is integration, which means you follow the herd, you want to be part of a social group. R, risk perception. Often our risk perception is flawed, our probability judgments are erroneous. We are very poor at dealing with risk. R, results. We look at results, we don't look at the process. O, overconfidence.
Okay.
R, recency bias.
Okay.
We look at what has happened in recent past and extrapolate it on to future. That's a very significant bias.
Yes.
And S, stories. We believe in stories, not in statistics.
Yes.
If I had to identify the major biases that characterize investors, they are captured in mirrors.
Okay.
And we have to guard ourselves against these biases.
Yes.
And I tell you, I am equally prone to those biases as you are or anybody else, because we are wired that way.
Yes.
And we have to find ways and means of mitigating our biases.
So how do we do this, sir? I mean,
excellent question. I've been thinking about this issue for decades now, and I've tried to incorporate that in my investment management.
Okay.
I've been managing my investments for a long period with a reasonably good track record, but I made my own mistakes. The lessons that I want to impart to everyone who wants to mitigate those biases are basically 5 or 6 or 7, let me say. 1, focus on the big picture. If you look at the levers of investment performance, there are 3 levers of investment performance. Strategic asset allocation, market timing, and security selection.
Yes.
The most important lever is asset allocation. Unfortunately, people pay very little attention to determining the right asset allocation for them.
Yes.
I often get calls from friends and relatives asking whether this is the right time to get into the market, whether this is the right time to get out of the market, whether I should buy this stock, whether I should buy that stock, someone has recommended this stock.
Stories
so
again.
all the questions are pertaining mainly to market timing and security selection. Nobody asks the question, what is the right asset mix given my investment goal?
Yes.
Everyone should spend more time in articulating the strategic asset mix decision.
Okay.
Strategic asset allocation should be guided by 2 factors, time horizon and risk tolerance. I have a simple 3 by 3 matrix which I'll share with you.
Okay.
You have medium time horizon, short time horizon and long time horizon, low risk tolerance, medium risk tolerance and high risk tolerance. If I have a long time horizon, let us say I'm investing for a goal which is 20 years, 25 years away. Someone like you who may be 30 years away from retirement may have a very long term horizon for your retirement goal. And if you are willing to take a lot of risk, you are tolerant to risk a great deal, which means that market volatility does not bother you much.
Yes.
I have a very simple rule of thumb which says if you can easily tolerate 10% fall in the market,
Okay.
but get a little unnerved by anything more than 10%, you have a low tolerance for risk.
Okay.
If you can tolerate 25% fall in the market in the period of say 3 months or so, but you become nervous when it exceeds 25%, you have a medium
tolerance. Okay.
tolerance for risk.
Okay.
If you can tolerate 50% fall in your portfolio in a short period of time, you have a high tolerance for risk.
Yes.
That is the way you can assess your risk tolerance over a period of time. While you may take the benefit of some questionnaire, the most important thing is how you react in a real life situation, not the questionnaire that you fill out in a very synthetic environment.
Exactly.
So if you have a high tolerance for risk, and if you have a long investment horizon, then you can put almost all your money in equities. That is a classic Warren Buffett.
Yes, sir.
You know, Warren
Put your
Buffett
eggs in
has put
different
almost
baskets
his
and-
entire wealth in equities because he has a long time horizon, because his investment is meant for a charitable cause which is away. And from the very beginning, he has been a very, very long-term investor. So that is a very extreme example. But most of us probably have a medium term horizon, or at least the psychological term horizon is medium term and medium tolerance for risk. So if you're not too sure about your tolerance for risk as well as your time horizon, start with a 50-50 option. That's a default option. Over a period of time, you learn whether 50-50 sell is a good sell, or you should get to 25-75, 75-25. So every investor will have to, over a period of time, determine his or her risk tolerance and time horizon and choose a strategic asset mix. That is the most important decision. I talked about focusing on the big picture. Second guideline is control the controllable. As an investor, you have to identify what is under your control. We can't control the final outcome, but we can control a few things very consciously. For example, we can refrain from watching the market on a continuous basis. If you want to insulate yourself from the emotional and corrosive influence of the market, look at your portfolio just once in a month. Be a passive investor. Minimize your taxes and transaction costs. Extend your time horizon, because if you extend the time horizon, you will experience lesser volatility. These are things you can control. Your time horizon, your exposure to market, your expenses, and the frequency with which you take decisions. The third guideline is rely more on words and numbers, less on sights and sounds. Don't look at TV. TV has a lot of sights and sounds. It has been psychologically proven that sights and sounds invoke the reflexive brain. Words and numbers invoke the reflective brain. And this is the most distinguishing aspect of Warren Buffett's investment. He doesn't look at a TV screen, he doesn't look at a computer screen. He looks at annual reports of companies and other reports. He is fully immersed in words and numbers. He is perhaps one of the most reflective investors the world has seen. That's a very important guideline in today's context. 4, follow a set of quantitative criteria that you're comfortable with.
Okay.
You may say, I'll invest in a company provided it has a growth rate of 10-15% achieved consistently the last 5, 10, 15 years. It has a return on equity of more than 12-15%. It has fairly clean annual report. It doesn't have a price earnings multiple exceeding a certain threshold. You define your criteria very carefully because quantitative criteria discipline us. Remember, our thrust is to mitigate the corrosive influence of emotions.
Yes.
So, you will have to do whatever you can to mitigate the corrosive influence of emotion. 5, diversify, diversify, diversify. Diversification is the only free lunch available in finance. There is no other free lunch.
Okay.
As Markovich showed brilliantly, diversification is the only free lunch available. If you have a portfolio of 15, 20 securities, you are able to virtually eliminate unsystematic risk without compromising on your expected return.
Yes.
You have to diversify across asset classes. You have to diversify within an asset class. You have to diversify across markets. You have to diversify across time. People should understand that diversification is a very important aspect of portfolio management. 6, do not forecast stock prices. In my 52 years of experience in the stock market, I have not come across even a single person anywhere in the world who can forecast stock prices accurately. Stock prices behave in a very random and unpredictable manner, but human beings suffer from a disease called prediction addiction. We want to forecast all the time because we are innately wired to forecast. That is how we have evolved over millions of years. We have to forecast whether it will rain, whether there will be a predator somewhere.
Yes, yes.
We are innately predisposed to forecasting. We have probably a module in our brain which I call the predictor module, and that applies to stock market even more ferociously.
Yes, yes.
Do not forecast stock prices. And 7, periodically review and rebalance.
Okay.
If I have a 50-50 stock asset mix, if I have decided that my investment of say 1 crore, whatever my investment amount is, divided equally between stocks and bonds, then periodically I have to review it. I have to review it at least once in 6 months to see whether they are in line with my target asset mix, and whatever rebalancing is required, you do it. So periodic review and rebalancing is required, because if you've chosen your strategic asset mix very carefully, you have to get back to it.
Yes, yes.
You can't drift away from it.
Yes, sir.
And I find that people don't do it because when the market is rising, they become Europhic and they become so excited that they are willing to tolerate a much higher exposure to equities. And when the market is falling, they run away from the equity market, reducing their exposure to equities.
Yes.
You have to periodically review and rebalance. All I am trying to say, Megha, is we are predisposed to errors, and these errors can be very, very costly in personal financial management. We have to find ways and means of mitigating these biases.
Yes, yes. And people tend to run to gold. It's a safe haven, running away from equity markets when it is falling. Like, so recently, when this inflation is hiking up, or there's a probability of a recession, when people are listening to these stories, people are trying to run away from the equity market and trying to invest in real estate or invest in gold or safe haven. So, sir, do you have any comments on these recent kind of happenings in the market, and how can we bring about the behavioral finance theories into this and behave rationally?
Yeah, the answer is very simple. If I have got my asset allocation right, let us say I have 100 lakhs to invest or 100 million to invest or whatever. I say, I can allocate 5%. I talked about diversification across asset classes. You have real estate. Within real estate, you have two categories, residential real estate and commercial real estate.
Yes.
You have gold and precious metals. You have bonds. You have equities. And then you have cash. If I have to look at most of the portfolios that I come across, these are the major asset classes, and you have to decide how you're going to allocate your 100 across these asset classes. For example, I may say you can have an exposure to gold up to 5%. You may say 3%. You have to figure out, how much of fascination you have for gold. Likewise, I find that some of my friends have a lot of fascination for real estate, and they have a lesser exposure to equities because they're more comfortable with real estate. Some are very, very conservative. They say they would like to put their money only in fixed deposits in nationalized banks, or they will put their money in liquid schemes of mutual funds. So everyone, depending on his or her risk tolerance and time horizon, will have to figure out. So remember, you have to review your portfolio every 3 months in a more dynamic and volatile environment. Instead of reviewing every 6 months, you review every 3 months. But don't do it on a daily basis. At the end of 3 months, if you find that something has fallen too dramatically, you will have to have the courage to invest in that asset class by pulling out from other asset classes. But very few people do that. That is the challenge.
Yes, sir.
We have the enemy within ourselves.
Yes, sir. You are your own hero and the villain.
Absolutely, you said it right.
Yes, sir. So, Professor, what are your suggestions to people who are new to market, or maybe youngsters like us who haven't had any past experience or who haven't faced any volatilities in the market? So, what do you think, and how can we incorporate the theories of behavioral finance into practice?
The best thing is you look at financial history over a long period of time. We have information on how various asset classes have performed for many years. In India, of course, information is rather limited, but you have information in the US for more than 200 years. You know how various asset classes have behaved over a period of time, how bonds have behaved, how equities have behaved. Everyone needs to be financially well educated in terms of how various asset classes have performed on the dimensions of risk and return over a long period of time. A sense of financial history is absolutely essential. And you should also know where the market is. For example, you can monitor the level of the market by looking at Shiller's P ratio or Warren Buffett's indicator, market capitalization to GDP or price earnings multiple or whatever. You need to have a sense of whether the market is in a fair price zone, whether the market is excessively priced, whether the market is very, very cheap. Everyone will have to develop that perspective. So that is an ongoing exercise, and I can tell you, if you are an investor, you are a lifelong learner. Every day I receive new surprises, and that is a part of this game. It makes it exciting, but also very, very challenging.
Adventurous, yes. Yes. So thank you, Professor. It was such an insightful learning, and we're looking forward to have you here again at CCRM. Thank you very much, sir.
Thank you, Megha, for the opportunity given to me.
Thank you, sir.